This is how you can scale 50K to 250K selling puts on commodities. Now, this is what I found to work best for me. And this is by no means like a main strategy. It's very opportunistic. So please bear that in mind. Now, my name is Eli. I'm a professional options trader. And in this video, I want to go over the strategies, the management, the position size, everything in between, the trade selection process, which is very, very important for commodities. Because it relies a lot on fundamentals, and obviously some live examples at the end. So let's begin with how to scale from 50K to 250K in about 6 years. So you're looking at about a 30% return per year compounded will get you there. And 30% return per year is about 2.2% return per month if you compound it. Now, for me, I try to collect about 2 to 3% of my total account capital and credit per position. And this is specifically for short puts. I want to make sure it's very clear. So in this case, if we have a 100K account, I will collect about $2,000 to $3,000 in premium per position. Now, usually we'll end up being closer to 2,000, but sometimes we can collect a bit more premium. It depends on the position and on the premium we can get. Now, if you buy treasury bills, it yields about 0.2% monthly on the account, at least as of now. And the total positions needed to close in a year is around 20 to 30 positions. So about 2 trades per month, give or take, for short puts. Now, very important, you always need to let fundamentals dictate your position entry and exit. And it's way easier than you might think. And we'll go over some detailed examples, how this whole process works. And it's really not rocket science at all. It's just something that takes a bit of practice to kind of get into the world of commodities and understand exactly what makes them tick, and just following simple logic, really. And you'll be surprised how amazing it is actually, and much simpler than trading stocks, for example, or selling puts on stocks. So next thing is you need to trade a moderate size and trade only when the odds are clearly in your favor. Like I said, fundamentals can clearly indicate the entries and even the exits as well. And I work with over $9 million of family capital currently. It's very possible to get 30% return with extremely low risk selling puts. I myself got a 26% return in 2025. Obviously, it was a combination of puts, short strangles. But just to kind of let you know, it is possible even with bigger capital and keeping the risk very, 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 very low. Let's continue on to the strategies, management, the position size, and everything in between. So obviously we're talking about short puts only. And why short puts only? Well, aside from natural gas, commodities usually crash upwards. So when price goes up, volatility goes up, and the other way around. So usually stocks, the S&P, the Nasdaq, they crash downwards. When they crash, volatility goes up. So selling puts on the S&P or on the Nasdaq is somewhat, it is pretty dangerous, right? It can also be very profitable, but at the same time, if there's some kind of major event that takes place on the weekend, the market opens up sharply lower, and you have some short puts, you'll be losing a lot of money. With commodities, again, aside from natural gas, they all crash upwards, which means if price goes up, volatility goes up. If price goes down, volatility usually goes down. So if you sell puts on commodities, you basically eliminate the risk of a down crash. Now, obviously, they can also crash downwards in very, very specific situations like tariffs and whatnot. But in this case, it's obviously you don't even, you don't trade the underlying because you don't really know exactly how things are going to react. But aside from tariffs, I don't think I've ever maybe COVID as well, where crude oil went down, but you wouldn't even be able to trade the options on it at that point. But aside from the tariffs, I've never seen commodities really crash downwards. By crash, I mean it just goes down very sharply and volatility increases. Prices can definitely go down sharply, but volatility will not increase, which is a really big thing if you're an option seller. So I will always take profit at 50% of credit, and I will take my stop loss will be 50 to 75% of credit. And again, I'm trying to collect up to 3% of my total account capital and premium. which this number is probably going to be closer to 2% most of the time. Now I will exit position if there's less than 21 days to expiration due to gamma risk. I will exit a position if there are major critical news that move the price and the fundamentals have shifted. We'll go over it. I will roll the position if the entry was at a bad timing, which can happen, and price is moving against you, but fundamentals have not changed. And the last thing, really important, margin requirements need to be up to 30% of the account per position. So if you have, for example, some short puts on gold, you need to make sure the margin requirements occupy less than 30% of the entire account. Really important for if price moves against you, so you have some room for margin to inflate if it needs to. Now it doesn't usually inflate, but or if it goes against you a little bit, but anything can happen, obviously, and we want to make sure we are ready for it. Now, something I didn't mention is I'm looking to sell closest to 45 days to expiration. The reason is theta is the most, or theta is really accelerating towards the, between the 45 and 30 days to expiration. Theta is going to really accelerate, and you can be out of the position really, really quickly. So this is one thing that is noted to mention. So let's go over the trade selection process. So step number one, I want to check the commodity volatility index, or CVOL, to find relatively high volatility. So as an option seller, I want to make sure we sell volatility, we sell volatility basically. Step number two, I want to analyze the chart. Is it the uptrend or a side trend? So if it's an uptrend or a side trend, then obviously it's good for us. We can sell some puts. If it's a downtrend, then obviously we want to avoid going against the trend. Step number three is we need to analyze the fundamentals of the product. Now this can be done by answering three simple questions. Is there a fundamental reason for the price to go up? Is there a fundamental reason for the price to go down? And are the news that caused the volatility to increase critical or non-critical? Really simple, right? So we'll go over a few examples. It's really, really simple, and you can just follow the news on TradingView, and it will tell you exactly, what's going on. It's really, really simple. So if, for example, we have a yes, no, yes, so there's a reason for the price to go up, no reason for the price to go down, and the news are critical, then it's a good, it's a good time to sell short puts. And the trick here is just to go to trade the things that are very, very obvious, and there's plenty of them. It's way more common than you might think. And every other combination is a lower probability setup for short puts. So I'm basically sticking to those three combinations of yes and no's. Now, step number four will be to look for a good position, short puts around 45 days, ideally, like I said. And obviously, if the price is like a new all-time high, we want to maybe wait for a pullback and then open the position, the short put position, which is also pretty important to note. And we need to make sure there are no big reports or events coming in the near future that might affect the price strongly. So, for example, if we know there's a big report coming for the corn, for example, in a few days, right? And we have all the indication to open a position, but there is that big report, that multi-USDA report that can come out on a Monday, for example. Well, you want to wait until the report comes out and only then reassess everything. It's really important to follow this, follow this kind of a less, least looked at step, because you can really make or break a position. And we'll go over an example exactly where it's very clear that you should just wait for all the reports to come out and then look for entries. It's instead of trying to guess if and enter a position and basically gambling your money while having an open position and going through some kind of major report. So let's go over the graph and look at some live examples and answer, check and do every single step to find a possible position. So let's go over a few examples. So first of all, these are the commodities that I'm trading. These are the ones that I have the most experience with and are the easiest to understand. And obviously they have pretty liquid options chain. So from gold up until to soybean. So there's only, what is it, 8 products. So you can probably realize that over time you can get really intimate and really understand each product and what drives the price up and down. And we'll analyze each and every product and based on the news that we see over here, which is basically the news that I'm looking at. So we'll go step by step. So first of all, step number 1 is to check for CVOL. CVOL, again, is the Commodity Volatility Index. You can just Google CME CVOL. It's you'll have to sign up. It is free though. And here we can see exactly what's going on. So let's begin with the metals. We have silver. And I'm always looking at the 3-month volatility. Here you can change it to 1 year and then 3 months and mark off the underlying. So we can see that the relative volatility for the past 3 months is really, really high for silver, right? So silver, something we can definitely be looking at, right? Let's look at copper. So copper, 3 months, kind of the same thing. It's in the upper 60 percentile. So volatility is really high. So we can also something we can definitely be looking at. Take a look at gold. So gold is somewhat an okay volatility, right? This spike in volatility happened due to some geopolitical tensions, and currently the environment is a bit different. So I will consider it an okay volatility. Maybe if you look at the month 1.5, 2 months volatility, see if we can just drag it a little bit more. So if you look something like that, it's still in the upper 60 percentile. I'm still going to be pretty happy with this volatility for gold. And this is something I do daily, even sometimes multiple times a day, right? Or you can just do it at the end of the day, just gonna go over and see which volatility is high or not. Now we also have crude oil, which is also a pretty high volatility, right? So this is step number 1. We have natural gas, which is somewhat okay volatility. I wouldn't consider it very good. If it would have been maybe at the 80s or above it would have been good volatility for me. And I'm not looking for the absolute highest volatility. I'm just looking for an okay volatility, right? For a good enough volatility at the upper 60 percentile of this range, right? So crude oil is somewhat okay. Corn, even though volatility dropped, volatility was much better. It's okay. It's not something I would consider for a position, but anything over the 18th volatility here, it would be much preferable. Now let's look at wheat. So kind of the same thing for wheat. I guess it's at the upper 60 percentile almost, but it's kind of on the edge. So if it's not clear for me, I'm just not going to trade it, right? So, and if we look at soybean, volatility is all the way down. So really nothing to be looking at for soybean. So the way I mark it is whatever is in blue is somewhat okay volatility. Whatever is in green is great volatility for the most part. So gold is, I would say, yeah, it's a good volatility gold for the most part. Now this is the first step. So basically we're going to be looking at everything that has a green flag over here. So let's begin with gold. We need to, second step is to analyze the trend. So clear uptrend for gold. We have a clear uptrend for silver, obviously, and we have a clear uptrend for copper. Now if we take a look at crude oil, well, it's not really clear what we have. It's somewhat of a big side trend, I would call it. So let's call it a big side trend because it's been kind of moving within a pretty big range lately, or for the past almost a year at this point. So we'll call it a big side trend because there's no clear direction, or maybe a slow creep down and then up. But this is good enough for me to be a side trend, right? So this is, it means that all 4 underlyings are eligible to go to the next step, which is the fundamentals. So we need to answer 3 questions. Is there a fundamental reason for the price to go up, to go down? And are the news that are driving the volatility up critical or not critical? So first question is there a reason for the price to go up? And the answer is absolutely yes. And, I'm not going to go through every single piece of news here, but basically there's a lot of, as I'm making this video, there's a lot of geopolitical tensions. U.S. prosecutors have launched a criminal investigation related to Fed Chair Powell. There's a lot of things going on. 25 tariffs on countries trading with Iran. So there's a lot of geopolitical tensions, which are very bullish for oil, for metals, and also a possible rate cut in the end of this month as I'm making this video, which is January 2026. All right, so all these things are very bullish for the price of gold, and as you can see, price has been moving up ever since September or the end of August in 2025. Now, is there a reason for the price to go down? And by going down, I mean, really crashing down. The answer is absolutely not. There is nothing in the news. There is no fundamental reason for gold to just kind of crash down. It can definitely go down. It can correct. It can go sideways, but there's no reason for it, fundamental reason for it to go completely down and against you, right? So, and the news are pretty critical, right? So there's geopolitical news. There's the prosecution of Fed Chair Powell. So news are pretty critical, which is pretty good for us. So we have a yes and no and a yes, which is a short put position for us, and basically a green light for us to continue to the next step, right? Now, if we analyze the silver, it's pretty much the same thing. Gold and silver are two precious metals, and they're both are basically reacting pretty much the exact same way to the same news. At least currently they have high correlation. So the same analysis that I did for gold apply for silver. Safe haven demand, lower rates, which is bullish for the price of silver as well. Next thing, we have copper. So copper, we can see it's been going up after this massive down move, and this is where we had all the copper tariff news. So what happens now is completely unrelated to that, but actually it is a bit related a bit. So what's happening here? Why is price moving up? Well, there's a few reasons. So the number one thing is there are concerns over supply prospects and potential import tariffs on the US. So we have a few things. So the reason for the price to increase is possible tariffs on refined copper, which is why there's a lot of demand for copper right now. US companies just buy copper because they don't know if and when the tariffs are going to be implemented. So they want to make sure that they stack up on copper supply. So this drives the price up. We have the concerns over the supply. So over the past few months, we had a few major mine disruptions, right? And again, this is not something that you have to know. This is something you just casually, at the end of the day, you can just check and see and go through the news, right? And see what's going on. Do we have anything new for this specific product, right? So we have a few mine disruptions. Some of them are really major, which really lowers or affects the supply of copper, and in turn drives the price up. If supply goes down, demand stays the same, price will go up. Very, very simple economics. The third thing is the rate cuts. So a lower rate is bullish for copper, like any metal. So this is also a thing that drives the price up. Now, are there any reason that can cause the price to go down sharply? And the answer is right now, no. But we know that Trump and the administration, they said that they will be revisiting copper tariffs this year in 2026, which means that at any point they can announce tariffs and price will completely collapse, right? And we don't want to be in a position where we have a short put and price collapses on us, and we have you just wouldn't be able to react, and it doesn't matter how small the position is, you will be hurting, right? So there's a possible big event coming up. You don't know exactly when, so there's no point in gambling here because we don't know when it's going to happen. So no point for us to look at any positions up until the tariffs actually announced, or there any news related tariff or tariff related news for copper that are being announced, right? So this is very simple, just risk management, right? So you can definitely sell some puts here. You'll probably be making money up until the price will crash, and it might not crash. We don't know, right? But we do know that something might happen, and we have that knowledge. So if you know something might happen, there's no point in going into the flames and trying to make something out of it. So next thing, we have crude oil. So crude oil has been kind of moving, I guess, up and down I guess, sideways for the most part. And what we know is, is there a critical reason for the price to increase? The answer is somewhat yes, because of more sanctions on Russia, maybe a bit more risk premium because of what is happening with Iran. They have almost a whole thing going on in there, right? As I'm making this video, so there's a lot of risk to the upside. We don't know what's going to happen, and prices been moving up for 4 straight days quite quickly because of it. On the other side, we have the narrative that's been going for quite a few months of global oversupply, right? So, and we have the situation with Venezuela, where if the reserves are going to be opened up there, there will be more supply entering the market, where everyone is already expecting oversupply. So we have both reasons for the price to go up and down, right? So in this case, it's also not going to be a really smart choice to sell puts on this product, on crude oil, because there are some very solid fundamentals that can drive the price down and up, and we just don't know how it's going to work out because it's just not very clear. So from everything that we went through, we have silver and gold basically to look at. So I would only trade one or the other. I will never trade them both because they're very correlated, especially in times like this. So next step will be, actually before we look at a possible position, it will be to just to check if we have any news or that might be coming for gold and silver. And the only news that we have is a rate cut at the end of this month, which has a super high odds of happening. Now, ideally, you want to wait for that rate cut to happen. It's also already priced in anyway. And if it happens, then it's kind of a green light for you to continue. You can definitely, in this case, it's kind of, I would say, okay to open before the rate cut announcement on January 28th, just because the odds are really, really high. But at the same time, knowing myself, I will probably wait until the announcement happens and only then look for a position, right? So let's say, for example, we ignore the January 28th rate announcement, and we look at the price action. So currently, we're basically at an all-time high for gold and silver. So for me to enter a position, I would want some kind of pullback. Any kind of pullback, 5-10%, 5 to 10% will be amazing, right? Because then we can have a much better entry for a short put. Now, let's say we do have a pullback, right? Which eventually will happen. There's always pullbacks, especially especially in sharp uptrends like these ones. So let's say we have a pullback, right? Let's imagine we currently have a pullback. Where would I choose my short strike? It's a big one. So in this case, if we just analyze the graph, really simply, we can see the price pull back a lot the previous time to the $4,000 level, and then kind of bounced off of it. So I would look to sell my short put at around the $4,000 put strike, or lower. Obviously, if price goes down quite a bit, then we can maybe go to 39.50. It will be better off. But for now, yeah, this is kind of my ceiling at the $4,000 level. Anything underneath it will probably be also okay. So my job is also to make money and collect credit, obviously. So it's also important to not go way out of the money and just open too many contracts. I want to open maybe probably 2 contracts for every 100K. So I want to make sure I'm getting paid enough for that risk as well. For silver, if we take a look at it, it's a bit more tricky, but probably the 50 level, which is way more, way out of the money, if you compare it to the, to the gold strike. So quite far away. Now let's look at gold, for example, and let's see what can we get on the option chain, right? So looking at gold, I'm looking at 42 days to expiration. So closest to 45 days will gonna be probably most ideal. Some people can probably go to 72 days, but let's look at 42 days and see what we can get for strike 4,000 on the put side. So, and we will probably gonna go 2 contracts for every 100K. So we can collect, and this is about $30,000 in margin. So right up the limit for this position, we can collect only about 1% of the account if we're looking at a $100,000 account, right? So this is a position I would open for a 100K account. Now, this is not enough credit for me to take the risk. I would at least want to get maybe $1,500. But at the same time, price moved up today a bit more. So if price goes down, our credit is supposed to go up, right? Now, if you take a look at the next cycle up, let's see here at 72 days to expiration, obviously we are going to get way more credit. Let's see here. Yeah, it's gonna be way more credit, more than double the credit actually. If we do 2 contracts, we're looking at quite a bit of credit, right? But at the same time, we are going to be in a position for much longer. So would I do that? Probably not. And also depends on when the price is going to go down. So if this cycle is going to be at 35 days to expiration and this cycle is going to be at 65 days to expiration, I would rather go to the 65 than the 35 and therefore collect a bit more credit. Even though 35 is going to be closer to 45 days to expiration, but at this point, it's, I should be already deep in the position. So I don't wanna, I don't wanna open anything with less than probably 40 days to expiration, unless there's really good credit, right? So this is how I would choose my strike, how I would choose my cycle, and make sure that my position size is not too big, which is really important in these situations. And then again, if price kind of moves against you and fundamentals haven't changed, then this is just a correction, and I would consider rolling the position to the next cycle, rolling out in time and down, or staying in the position if the unrealized losses is not that big. So all depends on what's going to happen, but this is basically the blueprint. And these situations, they happen. You just need to be really patient, and once you have an opportunity, you can strike, and it will do wonders for you. The biggest thing is let fundamentals dictate your decision making. If price went down and fundamentals completely shifted, where there's no more rate cuts, there's like global peace, which can happen, but not that quickly, not quickly enough to get you out of your short put position, in this case with gold and silver, right? And these are the situations we're looking at where the odds are clearly in our favor, and we can clearly generate income with a really high probability and certainty. So thank you again. Hopefully this video was useful for you. If you have any questions, let me know. I'll catch you in the next one. And yeah, happy trading, happy profitable trading for you.